IRS changes inheritance rules, assuring you pay more taxes. Oh, really? I made a mention this a couple months ago, just in passing. I've had a number of people send this an article thereof along these lines to me since, and I just like, did you actually read the article? Because you read the article, you're like, oh, okay, not nearly what the headline states. Look, I get it, clickbait. I use it, you use it, or you fall for it. I get it. But this is clickbait here. I mean, it's true. I mean, don't get me wrong. There is truth in this, without question, but it's clickbait. All right, so let's dive into this here. This is from Epic Times, or Epoch. I call it Epic. And you can see this guy, Mike Valles, something like that. All right. So until now, many, I chuckled this, many have enjoyed knowing their beneficiaries will inherit their assets tax-free through an irrevocable trust. All right. How many there, Mike Valles, have enjoyed knowing their beneficiaries could inherit their assets tax-free for an irrevocable trust? It has been used successfully to pass assets safely to children without tax. For many people, it will no longer accomplish that goal. All right, so the gist of this is you make a gift, and you use your lifetime gift exemptions, which is something like $5 million per person, $10 million for couples. I can't remember. Actually, let's look at the lifetime gift exemption. I'll tell you what it is. Actually, much more. For the year 2022, the exemption is $12.06 million per person. So what happens is you give a gift of $12 million to an irrevocable trust. Charlotte gives a gift of $12 million to an irrevocable trust, all right? And that is all tax-free. You're giving a gift to that trust, and it's out of your trust. I mean, it's out of your estate. It's in irrevocable, not irrevocable. Irrevocable, or irrevocable, if you want to say. Like we from Maine, who can't pronounce words very well, we say irrevocable. The bigwigs in Boston and New York City and even Atlanta, you know, the white shoes, Billy White Shoes Johnson types will say irrevocable. That's a gift. Irrevocable means it cannot be taken back. You're making a gift. You say, don't give it back to me. I don't have control over this asset anymore. I can't dictate where this money goes, supposedly, and it's not in my estate. I'm literally making a gift that I can't receive. I can't have any authority over it anymore. The reason I do that is to reduce the size of my estate. Why? Because check this out. We have basically a $13 million in 2023 estate tax exemption. And what I said right there about the gift tax was actually for 2022. So it looks like, yeah, so I'm sure this is the gift tax and the estate tax. So I was using 12.06 for the gift tax, but that's in 2022. In 2023, I imagine it's the same thing as the estate tax. So basically $13 million, dude. All right, so that means I can transfer, if I had $26 million in my estate, all right, I give $13 million to my irrevocable trust, or I could give it to anybody. It's not subject to estate tax. It's not subject to gift tax. Upon my death, my estate would also then have $13 million, which it could transfer estate tax-free as well. So that's 26 million schmackaroonies between me, another 26 million to my wife. So 26 times 2 is what, 52 million. We could transfer $52 million out of our estate completely, estate and gift tax-free. And that's just a fact, man. It's literally like that. And so you basically say, I'm going to gift half my estate. It'll avoid estate tax, and it'll avoid gift tax. I'm going to give my other half my estate. They'll receive it at death via my living trust, via my will. But either way, they're going to receive both estate tax and gift tax free. Make sense? Oh, and on top of that, guess what happens to the assets that the beneficiaries receive? They receive it with a step-up in basis as well. All right, so you own a business, you bought it for $1 million, it's now worth $5 million, and you're still in your estate. You die, that business transfers to your kids, estate tax-free, because it's less than the $13 million exemption. On top of that, the $4 million of appreciation, unrealized gain, transfers to your kids completely income tax-free as well. Because the irrevocable, because that's how it works, irrevocable trust or not. If it's in your estate or in an irrevocable trust, it's transferred to your kids with a step up in basis. All right. Now the IRS says, yeah, we're not going to do that anymore. The IRS says, let's go back. What we're going to do here is, as of March 2023, they changed the usefulness of irrevocable trust for many people in their revenue ruling 2023-2. It will eliminate the benefit of having this kind of trust set up unless set up correctly. The new document eliminates the possibility of avoiding capital gains tax by placing assets in an irrevocable trust. A growing number of Americans, what, a couple hundred, relied on this estate planning tool to quickly pass their assets to the children and preserve their estate with minimal taxes. Others used irrevocable trust to escape having to spend down their assets so they could qualify for Medicaid. Again, if you're using an irrevocable trust to qualify for Medicaid, we have a problem, in my opinion. I find that to be just, look, it's legal, 100%. I don't like it. And so the IRS is saying, no, we're not going to be able to do that anymore. So again, Medicaid is for indigenous, whatever it is, poor people. So people with a lot of assets would often set up an irrevocable trust to remove the assets from their estate. All right. At the same time, it place them under the trust control, which supposedly the grantor, who was giving the money to the trust, had no control over. And if you buy that, I got some oceanfront property in not Arizona, what's in West Virginia to sell you. How about that? Enabling the beneficiary to the assets to pass to the beneficiaries tax-free. Again, what happens is I have $26 million. I say, I'm going to take half of that at my death. I'll go to my kids estate tax-free via my will, via a living trust, a revocable living trust. I'm going to give this other half to my irrevocable trust. I'll name Uncle Johnny as a trustee. Uncle Johnny will then disperse that money to my children upon my demise, or whenever he wants. I can't say anything necessarily about that because I no longer have possession of the money or ownership stake in it or authority of that. Uncle Johnny will distribute it to my kids upon my demise. In this case, the assets in the trust get the step up in basis. The assets in the that transfer directly via my will or via my living trust get the step up in basis. No estate tax, no gift tax, no capital gains tax. It's a great system for that, for sure. But now they're saying when the beneficiaries receive the assets receive a step up value. It means they're given the fair market value at the date of death of the grantor, all right, at the grantor, instead of the date of purchase. So that would be you inherit the cost basis on a gift, which is literally. So if you just part two of this, if I were to give on that $1 million business that I bought for, it's worth $5 million now. If I were to give that to my kids, little Johnny over here, I already used Johnny, little freaking Myra over there, she's my daughter. Myra, my daughter. If I were to give that $5 million business to Myra while I'm alive, guess what? She inherits my cost basis of $1 million. All right, so you inherit the cost basis of a gift. So inherently, I'd want to give the irrevocable trust that $5 million asset, so that way when Myra inherited it would be estate tax and capital gain tax free because I get the step up basis. If I just made a gift outright to Myra, she would inherit it with my cost, not inherit it, but she would inherit my cost basis, if that makes sense. So if she were to sell it the next day, the $5 million asset would have a $4 million capital gain, which she'd have to pay tax on. On the other hand, if she inherited through the irrevocable trust, that $5 million asset she could sell the next day, again, assuming that the grantor or the trustee allows her to do that and have no capital gain on it. Or it'll be sold through the irrevocable trust. All right. In the new revenue ruling, the IRS says the asset is in an irrevocable trust are technically not part of the estate, and therefore estate taxes need to be paid. 100%, man. That means you're not in the estate. If it's not in the estate, there should be no step-up basis. The claim now the assets need to be under the direction of a will. That goal appears to be able to collect a lot more taxes on estate. Absolutely. Giving gifts to reduce your taxable estate. One of the best ways to reduce your estate and not have to pay taxes is to give it away. Right now, you can give up to, there is $12.92 million in the 2023 gift tax exemption. A couple can give away basically $26 million. After 2025, this exemption goes back to $5.5 million, where it was up until 2017. Yeah. Giving monetary gifts to your loved ones enables not just monetary, but just giving stuff away. It reduces your estate. It gets the money in the hands of the people you want to see how they use it. All right, so if you want to give little Myra there, say, I'm going to give you $100,000, see how you use it. If she squanders it, maybe you don't set up a big, don't give her a lot of money at your death. Maybe set up a trust for her to make sure she doesn't squander it. Giving money, and the growth of the estate is, the growth of those assets are out of your estate too. So it's a threefold. You're saying, I'm going to give you the money now so I can see how you manage it. The asset itself will be out of my estate, so it won't be subject to further estate tax, and the growth of the asset won't be subject to estate tax either, because in theory, that growth of the asset will grow at a comparable rate for Myra using it than what I would use it. And if it grew at a comparable rate, that'd be more estate tax at my death, if that makes sense. So gifting is a wonderful strategy. Big fan. The sooner you give it to your children, How millennials lost their grip on fashion? How dare you? The sooner you give it to your children, the more interest it gains, the more it grows. If you don't give it away, your estate can be taxed up to 40%. Yeah. Right now, you have $17,000 annual exclusion. The IRS says simple estates do not require to file estate tax. Yeah. All right, so there you go. Inheritance taxes. Yeah, I'm not gonna get all this right here. It's a good article. I just I don't. It doesn't concern me in the least, dude. Not in the least. Actually, it's got to be fair. If I give an asset to Myra while I'm alive, she will inherit my cost basis. If I can use an irrevocable trust to give an asset to Myra, it's not fair that she doesn't have she gets a step up basis on those assets. It's just not. It's not kosher in my opinion. What should happen is there should be a capital gain that she has to pay, or the estate has to pay. Someone's got to pay it, as opposed to being in my estate. You can't. You're basically getting the benefit twice. You're getting the benefit of making the gift tax free. You're getting the benefit of it being out of your estate, and you're getting the benefit of a cost basis step up. And that's not the way it should be. It should be no. You got 2 of the 3, but you can't have 3 of the 3, in my opinion. Unless you just give it outright to her right now. And if you were to do that, it'd be subject no step up in basis. Anyway, so people get really upset by this stuff because they haven't read the article and they're confused what this means. Literally not a big deal. It's just fair treatment, in my opinion. All right, love your thoughts. We'll see you